Talk to our next guest more about this. He expects the Senate to pass the bill in the next day or two, though warns changes in the House could push its total passage to later this month. Don Schneider is deputy head of U.S. policy at Piper Sandler. Don, it's good to see you. Did I get that about right?
Yeah, that's right. Thanks for having me.
So what exactly do you expect in terms of changes in the Senate, maybe then in the House? And the timeline you think is not going to be that it's passed literally by this Friday, but you think maybe later this month?
Yeah, so there's a few steps in this process. First, the Senate is in the middle of vote-a-rama. Maybe they pass this bill by tomorrow morning. Then it goes over to the House, and the House is debating just how much changes they'll need to make. Of course, this will change again through the vote-a-rama process. There will be more amendments. I think the key things that people are looking for right now, SALT, Medicaid, and the IRA. I think, we basically have a SALT deal as of now. I think the Medicaid language stands. And in the end, when it comes to the IRA, what is being debated is whether these credits cliff in 2028 or 2027. So, it's a massive deal for the industry, but in the scheme of things, all the budgetary decisions have effectively been made. Over in the House, there's some concern that, as your prior guest noted, that there's more deficit expansion in the Senate bill than in the House bill. But really, it's a product of more tax cuts. And in particular, they're the ones that people like the most: full expensing for equipment and full expensing for R&D. It's a decision to make those permanent rather than end after 5 years in the House bill. So in the end, if you're a fiscal conservative looking at this bill, you're getting more Medicaid cuts than was in the initial House version. The IRA language is stricter, and you have permanent tax cuts. Are you at that stage going to vote this down? Potentially. So I think it's a very high likelihood this gets done in July, but it's really a question of, are we doing another vote in the House, or is it kind of one and done?
And as it gets closer, it's not like the fiscal picture has improved from the bill all of that much, Don. And I see the 10-year at 4.24, and I wonder again how much of its tantrum earlier this year was even related to this legislation and what it does to deficits and debt levels and all the rest of it.
Yeah, I think there were outsized or really unclear expectations of what fiscal expansion was going to look like. I think the story is much more complicated now. The way I see it, we were on a trajectory where entitlement costs are going to rise, interest costs are going to rise, and that puts structural upward pressure on the deficit. Then in comes this legislation. It is meaningfully expansionary. I made the point, and you had up on the screen earlier. It's going to add 40 basis points to the deficit as a share of GDP this year. So we're going to go from about 6.4 to 6.8. And by the end of Trump's term, it'll climb to about 7.5% of GDP. So wow. a meaningful increase in the deficit. That said, tariff revenues are starting to come in. You can really no longer talk about fiscal policy without talking about tariffs. On an annualized basis, we have over $300 billion in tariff revenue that we are now collecting. So I think the net of all of this is the deficit will be roughly stable at around 6.5% of GDP. And in effect, what we need to argue about in the growth forecast is inherently compositional. The aggregate amount of dollars injected to the economy isn't necessarily growing, but the composition is shifting a ton. And I think ultimately tariffs are very harmful for growth. The sorts of individual income tax cuts we are getting in this bill are more demand side, not supply side. But of course, you have these really powerful corporate CapEx incentives. So that's the inherent dynamic that I'm watching. Do businesses feel confident that they can go ahead and make these investments in long-lived property, equipment, and structures, manufacturing structures, or does the tariff environment offset that?
Yeah, absolutely, and we don't really know yet. I mean, we've gotten, as mentioned, a few months of inflation data much better than expected, but I think the answer to that question remains uncertain.
Yeah, I would say to that point, the tariffs have basically just started rolling in. If you look at how much revenue we collected last month from the new tariffs, it's about $20 billion. We have a $30 trillion economy. It's going to take a while for all of that to really migrate its way into the data. So I wouldn't say, if we haven't seen nothing yet, nothing is coming. The tariffs aren't even fully phased in yet. So I think much more is coming.